Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
There's a lot of commitments going on out there in the technology world, Scarlet. Nvidia is committed to investing up to $10 billion in Anthropic. Microsoft is also committed to invest up to $5 billion in Anthropic. And Anthropic, for its side, it's committed to buy $30 billion of Azure compute capacity.
And
so
we're just throwing out these tens of billions of dollars like it's nothing.
Right. I don't get it. It's just the circular stuff we see, but people tell me not to worry. Coming up right here, the best dressed man on Wall Street. His turban matches his tie every day.
No accident.
I mean, nice job. Mandeep Singh, he's a senior tech dude at Bloomberg Intelligence. Mandeep, a lot of big companies making some big commitments in Anthropic. What is Anthropic again?
Well, Anthropic is one of the 5 frontier LLMs that are remaining. And they are leading the charge when it comes to generative AI. So it's one of the 5. The other one are Google, OpenAI, Meta, and XAI. And so, when it comes to these commitments, it's pretty obvious that OpenAI has raised the bar by announcing they're going to spend $1.4 trillion. So the question is, what are the other LLM companies going to do? And Anthropic is also a pure play LLM. And in their case, they don't have the funding. They don't have the balance sheet like Google or Meta have. So they have to raise the money either in the private markets or from someone like Nvidia, or get into an agreement with Microsoft, which also has an agreement with OpenAI. So that's where, LLMs need compute. That's how you serve billion plus users. And that's where, the numbers get bigger and bigger when it comes to tie-ups with cloud providers.
This is like the popular clique in high school where everyone knows each other and everyone's messing around with each other. Just give us a little bit of background here on Anthropic, because my understanding is that it was founded by folks who used to work at OpenAI, and some of the early investors, like big stakeholders, include Alphabet and include Amazon. And now you've got Microsoft in there. Is there anyone who's not part of Anthropic and not committed to investing in this company?
Well, you could say Meta, they're doing things.
They're doing their own thing.
They're doing their own thing in terms of, using the compute internally, and they don't have a cloud business.
Is that a problem for them that Meta's out there on its own? I know it doesn't have its own cloud business, but it's not buying stakes or committed to invest up to $5 billion or $10 billion in any of these AI companies.
So far, just to go to Meta, it feels like, investors were okay with them using the GPU compute for their own family of apps. But the fact that they're talking about 100 billion plus in CapEx for next year without having a substantial ROI, and what I mean by ROI is in the case of Microsoft, yes, they are raising their CapEx to $120 billion, but they're winning deals like the one with Anthropic, $30 billion in commitment from Anthropic. So somebody is paying for that compute in the case of Microsoft. You don't have that with a Meta. How are you generating ROI outside of your family of apps? And over there, you have to show a really substantial increase in engagement to convince investors it's worth 100 billion plus in CapEx.
Any of these OpenAIs, Anthropics, are they going to ever come public, do you think?
In the case of Anthropic, look, I know the numbers are getting big, but their gross margins at this point are probably better than OpenAI, which is doing too many things. The biggest risk I see for OpenAI is they feel they can get into any business, whether it's chip business, whether it's, obviously LLM is their turf, any type of applications. And that's where there's a possibility of a misstep. You can end up wasting time because you just don't have the capability. Yeah, the focus. Whereas Anthropic is more focused.
Dumb question of the day. Yeah. Are these U.S. companies, Anthropic, OpenAI, are they based? Where are they?
Oh, good question.
Where are Silicon Valley.
They're in? Yeah. Okay, so I'm going to go out there, visit my son at Santa Clara.
Yeah.
They're in the backyard right there. I can go knock on the door of ChatGPT.
They're not incorporated in Dublin or, some some island, the
I
Cayman
mean,
Islands?
look, it's a nonprofit looking to have a profitable
There you go.
PBC,
That's the thing,
and
yeah, okay.
so all that could happen. But look, at the end of the day, these LLMs are showing constant improvement, which is what's driving companies like Microsoft to partner with Anthropic. They had that exclusive partnership with OpenAI, but now they are diversifying.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Home Depot, they cut their forecast on weak remodeling demand. So I'll have to check in with John Tucker to see if that is in fact the case, because he is like the do-it-yourself kind of guy.
Really? What has he done in his house?
It does everything. And like big jobs that take a long time. Like he does the remodeling in the bathroom, and he does plumbing. He does all this stuff.
Oh, so
he
he's like
complains
Home
about
Depot's
lumber, that he can't get good quality lumber. He's got a guy that he
It's
goes
like their
to.
model customer.
Yes, exactly right. He's the guy. So let's check in with that. Drew Redding, he covers all the home builders. He covers all the stores that cater to the home builders like Home Depot. Drew, thanks so much for joining us here. What did Home Depot say about their customers?
So they came in with the same store sales growth of about 0.2%, which missed consensus. This quarter, that was largely due to weather. Last year, they had pretty significant gains from storms. This year, that wasn't replicated. So that had about an 80 basis point impact on the comp. And that's important because if you back that out, the underlying business has been relatively stable with about a 1% comp. So underlying trends still pretty stable. I think the bigger problem is that last quarter, they said that they had expected to see an acceleration in demand in the second half, and that hasn't materialized. We have gotten the pullback in rates, but that hasn't translated into better housing activity.
Yeah, and the problem there is that customers are deferring their large purchases. Demand has remained steady, but it's definitely not picking up at the same time. So when people are undertaking some kind of home renovation projects, they're just doing it at a smaller scale. Does Home Depot still benefit from those customers?
Sure, and that's what's driving a lot of the demand for the home improvement retailers. It's smaller ticket projects, maintenance-oriented type stuff, which is a huge part of their business. But to your point, to really see, I guess, the turn in growth, what you want to see is a resurgence in those big ticket categories. Now, big ticket spending was up 2.3% in the quarter, but that's more reflective of single item purchases. So think about things like appliances, power tools, gypsum. They also are taking share in the larger pro market, which is aiding the mix a little bit, but it really doesn't reflect an increase, as you mentioned, in big ticket projects such as kitchen and bath remodels or flooring projects. And that's really what we want to see turn, and will likely drive the next leg of growth next year.
So I ask about that big ticket items versus smaller projects because I wonder what this means for competitor Lowe's. Lowe's shares are down today, but only by about 1.3% versus Home Depot's 4%. And I wonder how much you can extrapolate from Home Depot to Lowe's, which will be reporting on the 19th before the market opens. So that is tomorrow morning.
Yeah, so for Lowe's, we're expecting to hear pretty similar commentary that we heard from Home Depot today. They're operating in the same environment with a weak housing backdrop, more cautious consumers. The main difference between the two businesses would be Home Depot's greater exposure to the professional contractor, which is 50% or more of sales, compared to Lowe's at about 30%. So we have seen on a relative basis more weakness among the DIY category, with particular strength in pro. So really that would be the only difference. But I think by and large, the sentiment is going to be that consumers are taking on more caution because they're increasingly worried about the outlook for the economy, the outlook for their job, and that's causing them to defer spending on discretionary categories.
How about tariffs? What are the companies saying about tariffs at Lowe's and Home Depot, like tariffs on wood, hammers, I guess? I don't know.
Sure. So not a whole lot of discussion this quarter. I think, given Home Depot and Lowe's scale, I think they're relatively well positioned to kind of navigate this environment with their suppliers. That being said, they're certainly not entirely immune. They kind of shifted their stance on their pricing strategy earlier in the year. They said that they wouldn't be raising prices, but as the situation in the landscape continued to evolve, they said they would be raising prices selectively. We did see that, I think, a little bit in the average ticket this quarter, the growth in that. But we don't really know at this point what the demand impact has been. There was a lot of noise in the quarter, as I mentioned, with the weather. So tariffs will certainly be something to watch, particularly since we just heard some new tariffs being introduced on lumber imports and as well as kitchen and bath cabinets, which increase significantly as we get into next year. So not a huge impact at this point, but certainly something to keep an eye on.
Okay, definitely. I'm curious, how much does Home Depot and Lowe's mirror what's happening in the housing market? Because when it comes to housing, of course, the affordability crisis is, the big thing that's keeping it frozen. Mortgage rates have come down, but they're still really elevated compared to where they were during the pandemic. Inflation is capping spending on big projects, and overall home prices remain really, really high. So people just can't move, and they're stuck in place, and they don't necessarily want to spend more than they can afford.
No, it's a great point. And housing is extremely important to Home Depot and Lowe's, as you would expect. The housing market has been stagnant. We're running about a 4 million annualized sales pace. That's about 25% below normalized levels. We know that when people list a home for sale or when they purchase a new home, there tends to be increased spending. Movers tend to spend a lot more than people who are already in their house. So they're certainly losing that piece of the business. I think one of the interesting things to keep an eye on looking forward is home prices. Home Depot and Lowe's have historically told us that that's probably the most important aspect of the housing market to them. And, as we well know, since 2020, home prices are up 50% or more, depending on the market. So owners have built up a lot of equity. But what we're starting to see now is prices rise at a much slower pace. And in a lot of key housing markets across the country, we're actually seeing year-over-year declines in home prices. So when you start to get declining home prices, that hits at that confidence aspect. If you think the value of your property is falling, you're less inclined to invest. So it's something they called out. It's not necessarily something we've seen at the national level, but if you look at particular markets around the country, it's something that's starting to happen.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Way back in the day at the Chase Manhattan Bank credit training program, exhaustive program. Mm-hmm. At the end of it, you had to do a big project, pick a company and do a detailed credit report on it. My company was Medtronic.
The device maker, the medical device maker.
Exactly right. So I knocked him dead, by the way. It was killer. Anywho, the stock's up 4% today. Some good numbers, 52-week high. It's good to be in the medical device business, I guess. I don't know. So we'll check it out. Matt Henriksson joins us here. He's senior Medtech analyst. He's based in Jersey, but you're in the big town today.
Yeah, commute in every day.
You come in every day?
Yeah.
Nice. Good for you. That's what I'm talking about.
And driving, too.
What?
Oh, yeah.
You drive to where?
Parking lot right out there.
Dude, and you do the congestion pricing?
I have to. Yeah.
Where do you drive from?
Well, Ridgewood. So
we have trains, dude.
I know, but the Secaucus Junction, it's always a mess.
Oh, my God. What a knucklehead. All right. Matt, thanks for joining us here. I have some serious problems with your commuting strategy. Talk to us about Medtronic. What's going on there?
Well, let's take a step back 12 months ago. They had a lot of promising products in the pipeline.
Yep.
The question was execution. And what we're seeing the last few quarters is you're starting to see some of that execution. So when they raised their organic revenue growth guidance by 50 basis points today to 5.5%, that was driven a lot by what they call as their cardiac ablation segment. This is new technology that's being used to treat atrial fibrillation. That segment alone grew 71% year over year. So having that as off a $1 billion revenue run rate is what's driving that kind of growth and is what is expecting to accelerate that growth going into fiscal 2027.
Wait, 71% is going to get bigger?
Yes, they actually said that. And we actually, in our follow-up questions with them, we asked, just to confirm, are you going to accelerate that 71% growth in their fiscal third quarter, which is the one coming up? And they said yes. And it's basically the adoption of, without getting too technical, it's called pulse field ablation. And it's a new way of ablating the heart to treat atrial fibrillation.
Does it have a main competitor in this space?
Yeah, so it's kind of turned into a duopoly right now between Medtronic and Boston Scientific. The ticker is BSX. And what you saw this quarter is Boston Scientific was in first, and their growth in the quarter was 60%. So Medtronic is highlighting that it was actually growing faster in the quarter than Boston, its main competitor, was.
How's these medical device companies like Medtronic, and how are they dealing with this administration and, I don't know, tariffs, regulations? What's the backdrop for the sector of the healthcare space? Yeah,
so if you look at broadly, it should be more insulated than some of the other kind of import-export type of businesses. Procedure volumes remain steady. Devices that are used in the U.S. are mostly built in the U.S. There's some caveats here and there. So it's overall relative to the broader market minimal. Medtronic highlighted that the worst quarter is going to be coming up their fiscal third quarter, which ends in January. A little bit worse in the fourth quarter that ends in April. And then they haven't gone too much into fiscal 2027, but they said it should be incremental. Overall, it should be about 180 million to the overall net income. But that's talking about a company that's making 30 billion plus in revenue per year.
What I noticed as well is that Medtronic has as one of its biggest investors, Elliott Investment Management, the activist investors. And yeah, they've become one of the biggest shareholders earlier this year. And they've made some changes, adding some folks to its board as independent directors, presumably ones that Elliott finds favorable. What does this mean for that relationship? Is this an antagonistic relationship, or is it something that's a little bit friendlier?
I would say more it's a friendlier type of relationship. And I think it goes back to what I was talking about 12 months ago when we were looking at a company that had all these promising developments in the pipeline, and they just couldn't get that revenue growth from the 4 to 5% up to that 5 to 6% where we're seeing now. Now, the question is how much of that is behind the scenes Elliott is making a push, or just the fact that the management team just needed that extra time to get that initial acceleration of the growth just internally. But yeah, they came in, I mean, honestly, at the right time with kind of when it was down, more than 20%.
Yeah, I'm not used to seeing a potentially friendly relationship between Elliott and the target companies it targets.
Yeah, exactly. Good point. But maybe it's working in this particular case. Matt, thanks so much for joining us. Appreciate it. Matt Henriksson, he's a senior Medtech analyst, Bloomberg Intelligence. He of the questionable commuting strategy. We'll discuss that a little later.
What would you do if you were him?
Oh, train, dude. I mean, I live in New Jersey for that reason only.
Is that New Jersey Transit or is that another one?
Yeah, but he lives in Ridgewood, which is beat for no rail service. Good. You gotta go to Secaucus.
You're kind of almost supporting my thesis there.
Yeah, but you don't come into the city. I mean, there's a river
Paul's
there for a reason.
problem is with the driving into Midtown.
Yes, you go to Secaucus, you hop on a train, you're in, and then you're done.
Drive to Secaucus.
Yeah.
No, but
or I do my 5:30 commute too.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Amer Sports. That's Salomon. They got the Salomon best
the
bindings.
Ski company, right?
The best bindings in the world, I think. I've been skied on Salomon bindings for like 40 years. But they had lots of other stuff, Wilson Sports and all that kind of stuff. They had some pretty good numbers today. I mean, raising their guidance for the third time this year. So, I don't know, the consumer seems,
I think in the K-shaped economy, they serve the upper leg.
Upper part of the K?
Yeah.
All right, that's the place to be. Abigail Gilmartin joins us here. She is the footwear and athleisure analyst. I don't know what athleisure is for Bloomberg Intelligence. She's a proud Spider. University of Richmond Spider.
Oh, there you go. I didn't know that was the mascot.
Yes, it is. Wow. It's very unique, isn't it?
I can't wait to see what that T-shirt looks like.
Oh, yes. It's a big spider.
Yeah, we'll get you we'll get one for you. I got my 40th anniversary at University of Richmond coming up this year. This spring.
Are you going to go?
Damn right, I am going. I might actually join the committee to force me to kind of go. So I'm on the committee. I'm in charge. I'll be dialing for dollars, getting people to come. And Abigail's, she's a spider. Talk to us about AMER Sports here. I don't think a lot of people know them too well.
Yeah, no, because the brands underneath it is Arc'teryx, which is their outdoor performance brand, as well as Salomon and Wilson are their three biggest. So I think today was a big day for them. They did really well. Sales up 30%, broad-based strength across regions, across channels, and across brands. I think the key thing people were looking for was China. Arc'teryx recently had some controversy in China with a fireworks display in the Himalayas.
What?
Fireworks display.
Who displayed fireworks in the Himalayas?
Arc'teryx for set off fireworks.
Why?
Exactly. It was definitely a misstep for an outdoor brand that's really focused on sustainability. And there was definitely some concern that there would be a little backlash in China. There's definitely a lot of people upset about it, and they were fined by the Chinese government and working to restore the ecology there. But Greater China was up 47%. Momentum is continuing into 4Q. So I think that was really a big takeaway, just quelling investors' concerns about potential backlash in China, especially because they're the number one outdoor sports brand in China, Arc'teryx. So it's a big market.
I had no idea that they have such strong brands. I mean, Amerisports on its own is kind of, it's not memorable, the name, the parent company name, right? But the brands, of course, are Salomon, Arc'teryx, Wilson, as you mentioned. What does the tariff picture look like for this company?
Yeah, I think it's very similar to most of the other companies. I think for them, what benefits them is their premium positioning. They're able to raise prices and they're not seeing any backlash from consumers or pullback. They're still seeing very strong full price sell through. So they're able to offset some of those tariff costs with that, which I think is really helping. And we're seeing that with a lot of more of the premium brands are able to kind of navigate through the tariffs since their consumers are willing to pay a little more.
Upper K of the K-shaped economy.
I guess I know that's I guess where you want to be there. Talk to us about the footwear market here. I think Nike, Adidas, all that kind of stuff. What's going on there?
Yeah, I think we're in store for a very interesting holiday season. I think that we're going to continue to see the premium brands continue to do well. On Holdings recently just reported and did phenomenal, and they also said they're not seeing any backlash on raised prices, and they'll continue to do limited discounting through the holidays. So we may see some differences between the two companies, but we just had our recent BI survey, and Nike continues to lead. I think there's been concerns over Nike, but they still are the major shareholder and still a favorite brand of millennials, Gen Zs, everyone for the holidays. So they should continue to do well too.
What is Amerisports' distribution strategy? Do they have a DTC offering, or are they going through third-party retailers?
Yeah, that's a great question. So it's a little different for each brand. For Arc'teryx, they're leaning a lot more into DTC. They've changed their distribution strategy from basically 80% wholesale to 80% DTC over the last 3 years. And they're really focusing on growing their store base because I think not a lot of people know about Arc'teryx. It's really going to help the brand awareness. So even in the US, they're looking to double their store count by 2030. So that's that. Through Salomon, continues to be wholesale, especially for footwear. We're seeing this holiday season, consumers strapped for cash. They're wanting to go into the stores and try on their shoes and make sure it's the right fit and buy them versus, buy 5 pairs and return them.
Yeah.
So the wholesale distribution for Salomon is really key, and they're in a lot of key premium partners, I would say, and the running specialty stores as well.
I mean, I'm looking at your report here, research report on the sneaker business. I didn't know there were so many shoe manufacturers. I mean, Nike's the dominant one, as you said, but there's like 14 in your survey here.
Yeah, and
that's a competitive marketplace. Definitely.
It's getting even more competitive as consumers with AI, technology, there's just such more of a breadth of discovery. So that's where product is really coming into play this holiday season, I think, innovation, product, and style.
Abigail, if there's one thing to be worried about when it comes to Amerisports, what would it be? I mean, what's an area that they're not executing on?
So I think the China thing was the one uncertainty for this quarter that we were it could have gone either way. So that would be the biggest thing. But honestly, they're executing on most of their things. Their biggest drivers are DTC, women's, and China, and all of those were up double digits and more. And they're really gaining share in women's, which I think is a big new opportunity for them as more women join the outdoor market.
All right. Which have you purchased in the last 12 months, sneaker brands? For baby boomers. Skechers.
Yeah.
What?
Yep. Skechers continues to win.
What is that?
Honestly, they're so comfortable. They're like the price point, the quality. I know. But you'd be surprised.
That is not something that they market out there, that they put out there.
No, right? They're the third largest footwear brand globally.
Really?
Yeah, I think right behind Adidas.
Next, you're going to tell me that,
Wow.
the boomers are using the shoes with the little wheel in the back of the
No, the wheelies. The wheelies.
Yeah, no, they're doing the step-ins. You don't even have to bend down for your shoelace. That's it.
That's what I think it is. Yeah, okay, I think you're right. All right.
I mean, yeah.
There you go. I mean, the kids, the Gen Z, the millennials, they're still in that Nike brand. That Nike brand still, and Adidas.
Or Hoka's.
Yeah,
Right?
Hoka and On are gaining, but they're still small, and I think people don't realize that just because there's been such a big boom. They're still very like West Coast, East Coast oriented. They still have a lot more room to grow brand awareness in the U.S., especially in the middle of America. Nike continue, and they're higher price points, right?
Yeah.
Not everyone can afford them.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.